To the cloud. Hello and welcome everyone. My name is Peter Robinson and today I've got Adam and Isabelle from Lion's Mane and they're going to talk to us about Tracer. So before you share your slides, could you please introduce yourselves?
Yeah, sure. So my name's Isabelle. Most people call me Izzy. I'm a mechanical engineer by trade actually, so I have quite a substantial history in aerospace and rocketry and mining and machining. So lots of sort of boundary pushing technologies, but I did a bit of work in payments just out of interest and have found myself building quite a futuristic financial space. So yeah, that's me, Bawi.
Yeah. I'm Adam. And yeah, so I basically, my formal background is in chemical engineering and finance. I basically came into the space in 2017 when I saw the rise of Ethereum and Bitcoin. Obviously, with a bit of an analytical type mind, I wanted to know how things worked. So inevitably came to the point and conclusion that I wanted to get a part of building the future of finance.
Sounds awesome. So yes, please share your slides.
Absolutely. Alrighty. And there we go. Cool. Well, might kick it off. So yeah, as we said, Izzy, Bawi.
Adam, yeah.
Adam, sorry.
I'm Adam, yeah, we're from Lion's Mane, and yeah, we're here to talk to you about Tracer. So who is Lion's Mane? We're a team building out the Tracer protocol. Our role in the Tracer ecosystem will be in guiding software, marketing, funding, and research initiatives. We've got a really strong and clear vision for what the Tracer ecosystem could look like, and we're working really hard each day to develop and communicate this vision in an open source environment. We thank Peter for allowing us to present today. It's a wonderful privilege to speak to you all. We're very excited to share Tracer with you. We've got some time set aside at the end of the talk to answer any questions, but throughout the presentation, we're happy to respond.
Cool. So I guess the first point we really want to start off with is what is Tracer? And we can distill it into about 3 key points. The first being that Tracer is open source, secure, peer-to-peer financial infrastructure, meaning that the protocol itself is comprised of these trustless financial contracts, which mean that the individual or entity who chooses to use them doesn't have to worry about relying on a middleman to facilitate transactions. Tracer is financial infrastructure that people can rely on and is really effective at managing financial transactions on a daily basis. Now, in comparison, our financial system currently is full of intermediaries that take clips with very little transparency about what they're doing. And different types of contracts existing require unnecessary licensing, they have capital requirements, meaning that they're really difficult for an everyday person to access. Tracer itself solves this and arms everyone that uses it with the power of global access. Now, number 2, traditionally, it's been really costly to deploy and develop new contracts. There are so many hoops to jump through. There are barriers to entry, massive bureaucracy costs to overcome. Within Tracer, there actually exists an environment where innovation is really incentivized and can be explored. New markets can be pioneered with the Tracer protocol. For example, we still don't have a sophisticated market for water or for air, other essential ecosystem assets, and we think we would derive great benefit from gaining price insurance for these and managing global supply and demand. And finally, Tracer is a democratized protocol. So we're currently detached from and quite disenfranchised by the current system. And with Tracer, users, stakeholders can all be involved in governing the contracts that they actually use day to day. And by enabling people to have this really tangible voice and vote, they can actually meaningfully interact with and optimize the system that they live in. So Tracer's foundations are very firmly placed in DeFi and the industry that is forming, on Ethereum. So to understand the project's roots, we're going to just briefly touch on and explain DeFi and Tracer's position as a solution. So decentralized finance, as you probably know, is a movement that has seen light in the last few years, forming a totally new industry. We're seeing so many inspired hackers, economists, financial engineers, all focusing together on building technology that doesn't rely on these third parties to function. And these are financial contracts that permit things like lending, borrowing, exchanges, derivative transactions, anything entirely peer-to-peer without having to know or trust this counterparty whatsoever. And we've seen some pretty incredible growth in value secured by DeFi, from less than $1 billion in the start of 2020 to more than $100 billion today. Now, it's our assumption that inevitably all financial contracts and transactions will be performed, settled, cleared on a blockchain using decentralized infrastructure. This new financial system, which is powered by blockchain, will be secured by these cryptographic guarantees and game theoretic principles. So this means that, as I said, trusting an intermediary who rather relies on their reputation and a legal system to back them, we can now rely on secure smart contracts and really great mechanism design. And what we're seeing, the financial contracts as they exist in DeFi right now, we're seeing them become building blocks for different types of applications and transactions. So for example, we see transactions like flash loans occurring on Ethereum, where someone can borrow and repay a loan in a single block. And this allows them to increase the amount of capital and best seize arbitrage opportunities on exchanges. Now, because all of these transactions are taking place on the one layer, being Ethereum, the financial contracts and applications consist of many different types, all bundled up into the one transaction. So keeping it on a relatively high level, positioning Tracer, it's a financial protocol built on top of the internet. And the internet obviously allows anyone in the globe with a Wi-Fi connection to connect into Tracer's infrastructure. Our Tracer's security and consensus properties are attained by building on top of Ethereum. It gives us, credible decentralization, immutability, and guaranteed uptime. The Tracer protocol itself is a set of fundamental smart contracts, such as Tracer DAO, Tracer Factory, and these bring life to the financial ecosystem. And any application interface, you can think smart contracts, you can think users facing an exchange like Binance or Coinbase, or an exchange company itself, perhaps the ASX or CME group. All of these parties can plug into Tracer's financial infrastructure and provide users with access to secure financial markets. So let's get into Tracer protocol a bit deeper. So to achieve financial democracy, which is highly desirable, Tracer protocol is governed by a DAO whose members vote on proposed changes to the protocol. Tracer DAO effectively owns and governs the Tracer Factory, which hosts a variety of standardized financial contracts. These could be, as I sort of touched on before, they could be derivative contracts, lending, borrowing, exchange. And once these contracts are installed into the factory, they can be deployed by anyone, which removes all barriers to entry really for financial tools for the individual, and also enables Tracer protocol to pioneer new and innovative markets. Now, each contract that is deployed from the factory is a standalone market with open source code and a set of fixed rules. Now, this setup itself maximizes contract scalability through standardization. Everyone agrees on the contract terms as they are in the factory specs, so there's no conflict there. Now, the first financial contract to be installed from the factory that we're really excited to share with you today is the Tracer Perpetual Swap.
So let's now move into unpacking the first component of the Tracer protocol, the Tracer DAO. Traditionally, shareholders, managers, and directors coordinate to make decisions in a company. In our first financial system, you have a handful of bank executives or leading figures of federal banks that set rates and determine which standard financial systems we, the people, should abide by. Many have become disenfranchised by a trusted political and institutional elite that makes decisions which affect our everyday financial transactions. More often than not, these decisions are not in the best interest of the individual, nor do they represent their values or preferences. Decentralized governance through DAOs have the ability to give a voice back to the individual and enable them to vote and decide on the financial terms they agree on a daily basis. Decentralized autonomous organizations, or DAOs, are a digital evolution of traditional corporations and governance systems. A DAO is essentially a set of smart contracts which define an organization's rules. DAOs do not require central ruling power and can be achieve distributed control between all members. Members are able to propose and make changes to financial agreements and protocols that they participate in. Effectively, DAOs lower the cost of coordinating around specific issues, and voting can be conducted in fraud-proof ways that are very difficult to game or exploit. Tracer DAO governs the Tracer protocol. Tracer DAO itself can be observed as a collective made up of individuals and groups of people that are passionate about creating systemic change within the financial world. And ecosystem initiatives such as security audits.
Adam, I'm not sure if it was just me, but I think your internet froze for a sec. Was it?
I missed it too.
Yeah, I'd say rewind about a minute.
1 minute. Yeah.
Yeah.
A minute. All right. So we got through this portion? We go to Tracer DAO. So the Tracer DAO governs the Tracer protocol. Tracer DAO itself can be observed as a collective made up of individuals and groups of people that are passionate about creating systemic change within the financial world. Physically, Tracer DAO is a set of smart contracts deployed on Ethereum. Tracer DAO will curate the factory, provide public goods funding, and govern specific markets. Market fees are collected in the Tracer treasury, and the Tracer DAO can distribute them by proposal to Tracer DAO service providers and ecosystem initiatives, such as security audits. Contracts that have been deployed from the Tracer factory can be DAO governed if the deployer chooses the contract as so. If governing an individual market, Tracer DAO will perform upgrades or real-time modifications to smart contracts by way of vote. Tracer DAO is functioning as effectively as possible to serve the individuals that are using them. So how can the DAO vote on proposals? Firstly, Tracer governance rights grant people the right to propose and vote in the Tracer DAO system. It's also worth noting that anyone in the community can actively discuss and debate governance decisions in Tracer's open community forums such as Discourse and Discord. From these discussions, a DAO member can put forward a proposal for change. The merits of each proposal can be openly discussed, eliminating ambiguity and encouraging open decision-making. Finally, the process takes place on-chain. The outcome of a vote will typically direct a change component within the Tracer protocol. This could look like a movement of funds from the DAO treasury to grant a recipient, a financial contract being installed into the factory, a contractor service provider, or any other on-chain activity.
All right, so RMIT University's Blockchain Innovation Hub, or we call them RMIT BIH, they've partnered up with the Tracer DAO to provide academic foundations for the protocol. And they're actually one of the teams who've been accepted by a proposal to be working with Tracer DAO. So RMIT BIH, they'll be working within the ecosystem to develop and formalize fundamental governance frameworks. This means they'll be documenting and exploring the roles of oracles and actually more studying the decentralized financial markets that have been deployed within Tracer infrastructure. Now, one really exciting piece that RMIT BIH are working on is the topic of commitment voting, which, if you're unfamiliar, is a form of voting that allows people to signal intensity of preference. Now, Lionsmain, we're working alongside RMIT BIH to bring this commitment voting to fruition. Feel free to check out the paper. It's displayed there on the slide. Otherwise, you can just Google commitment voting and their paper is the first one that comes up. Now, already RMIT BIH's contributions to Tracer have been so valuable. They've been authoring white papers detailing the protocols and just being a great supporting player. Now, DAO governance itself is an entirely new paradigm and has very little research completed on it since it emerged in 2016. And RMIT BIH's economists and social scientists, they're so well versed in traditional governance structures and are able to provide really solid theoretical foundations for Tracer. Now, as we sort of mentioned, RMIT BIH are just one team who have joined the Tracer ecosystem. There will be many more to come, including financial engineers, security experts, researchers. All of these will inevitably join the Tracer DAO to help build the ecosystem out. Right, so at the core of Tracer is the factory, and this is where contracts can be installed, modified, and deployed. The factory architecture simultaneously supports many different contract types, as I said before, lending and borrowing, derivatives, exchanges, and the name actually originates from a design pattern you may be familiar with if you're in software engineering, known as the factory method. In Tracer's context, this pattern allows any financial contract to be installed as a template and allows one to imagine quite a compelling image, really, of a digital financial factory that is mass producing these contracts at a super large and efficient scale for the individual. Now, once the DAO has voted to accept a financial contract template and it's installed into the factory, any individual or entity can deploy the contract and create a market. So as we have here, the Tracer factory can deploy and host these contracts like options, perpetual swaps, lending and borrowing, which are featured, but really the factory can host an unlimited amount of these contracts. If the DAO members themselves or market participants feel that the contract rules are inequitable, inefficient, insecure, they can propose changes to the contracts through a vote. And in this sense, people have a real and tangible way of governing financial agreements. Now, for the installation of a totally new factory template, like perpetual swaps, the proposal can be put forward by a DAO member and upon passing is installed. In many senses, this makes the DAO and the factory model very similar to a financial contract incubator that provides clear incentives for engineers for bringing these financial contracts to life. And for such work performed by an engineer, contract fees can be paid as a royalty, and you can have grants or direct employment initiated by Tracer DAO. Just like we, Linesmain, have been contracted by Tracer DAO, we imagine there'll be a lot more teams joining us on this mission. So let's run through briefly an example, particularly on someone creating a Tesla perpetual swap market by deploying it from Tracer Factory. So here again, contract installed into Factory after being accepted by Tracer DAO. Any user with an internet connection can deploy this market. You can see them there on the screen. This deployer chooses to call a function within the Ethereum smart contract that triggers the deployment of the perpetual swap. Alongside this function call, the deployer needs to specify a few contract details, like that it is a USDC ERC20 token that will be used for clearing, settling the contract, as well as the fact that they would like a specific Tesla Oracle price fee. Given these inputs, the Tesla USDC market was created. It's live and anyone can trade. It's as simple as that. So, in addition, it's also crucial to understand that some markets that have been deployed from the factory can be governed by the DAO if the deployer specifies in the deployment they desire DAO governance. So the factory and the DAO design both demonstrate quite a steadfast approach to contract upgradability, designed to enable Tracer to adapt and scale and become the protocol that governors and users need it to be. For example, again, a user of the perpetual swap market, like those we're showing here, may believe that an insurance pool target adjustment would create a more efficient market. They can present this case to Tracer DAO via Discord, engage with people on Discord, discuss their proposal. From here, a formal proposal can be created by a DAO member and put forward for a vote. If this vote passes, the variable targeted, in this case, the insurance pool target, in the perpetual swap financial contract in the factory is immediately modified. And the only costs sort of associated with this process from end to end are gas related. So from this point onwards, then any deployment of a perpetual swap would have this upgraded insurance pool target. The factory is structured to provide incentives for such innovations. New financial contracts that are proposed can include clear remuneration terms for both creators and modifiers. And with this incentive in place, it's quite foreseeable that entirely new and exciting markets will be pioneered. There are some necessary conditions for derivative and spot markets to emerge, which we highlight quite well in the Tracer white paper. But given these conditions, the factory model could incentivize formulation of derivative markets for things like water, fuel, and oxygen. So any research and standardization costs associated with forming these markets can be subsidized initially by Tracer DAO, obviously if there's demand existing in the community. And with this in mind, Tracer protocol can evolve into an entity that we may imagine as a distributed CME group, perhaps, that creates global standards for derivative contracts.
So the Tracer's first financial contract that will be installed in the factory is the Tracer Perpetual Swap. Before talking about what a perpetual swap is, though, it is pivotal to understand what a derivative is. Derivatives are contracts that derive their value from the price of an underlying asset. The most common underlying assets include stocks, bonds, currencies, interest rates, and market indexes. For perspective, the total value locked in derivatives can be compared to other global markets. DeFi currently sits at a global value of $100 billion, cryptocurrency at $360 billion, all the way up to derivatives at a whopping $1 quadrillion in value. Not many people actually know what a derivative is. Well, a derivative is a financial contract between two or more parties. Derivatives can be used as effective risk mitigation tools, allowing you to hedge or gain price insurance for a fixed commodity or asset. On the other side of the trade, you can usually find a speculator that is seeking a capital efficient way to gain market exposure. Good derivative markets allow for great price discovery and permit businesses to consistently function all year round and provide goods and services for people at a consistent price. Take McDonald's for an example. They'll lock in the price that they pay for beef using either an options or futures contract so that they can guarantee that they can still make a profit when selling a Big Mac for $3.50. These hedging tools currently don't exist for the individual. In many senses, we're at the whim of our retailers. One day we could be paying $3 for a kilo of bananas at the supermarket. The next day we could be paying $8. As individuals, we should have more meaningful ways to manage our finance. Derivative contracts are a really simple, capital efficient way to do this. Before Tracer, there has existed no reliable way for individuals to gain price insurance and hedge their individual consumption. There are many different types of derivative contracts, although most of them can be boiled down into 4 agreements. Futures and options are 2 popular derivatives in the capital market. In 2020, 26 billion futures contracts and 21 billion options contracts were traded. This is talking the amount of contracts and not volume, which is in hundreds of trillions of dollars of value. An option grants the contract holder the ability to either buy or sell an underlying asset for a specific price within a predetermined time frame. In contrast, a futures contract obligates the 2 parties involved to make an exchange at a certain future date. Perpetual swaps are a new type of derivative contract pioneered by BitMEX in the last 10 years. Since their inception, perpetual swaps have gained increasing demand in the market as a highly effective way to gain leverage exposure to many different markets, as well as an effective way to hedge your asset value and earn a fixed income through an interest rate payment. This demand is reflected in the amount of total volume traded in perpetual swap contracts. Daily liquidity volumes from major exchanges increased from 5.1 to $189 billion in less than a year. So what is a perpetual swap? A perpetual swap contract is a derivative that enables counterparties to gain long or short exposure to the real world value of an underlying asset for any amount of time. Users can predict the price to go up, which is a long position, or predict the price to go down, a short position. Perpetual swaps provide a capital efficient way to gain leverage exposure to any market in the world for a low transaction cost. A perpetual swap basically mimics the experience of holding the underlying asset, but you're either paying or earning an interest fee through a funding rate, which is a mechanism that will be touched on a bit later. So the table here is to convey a few of the properties of perpetual swaps compared to other financial agreements. The perpetual swap is similar to a futures contract, but has no expiry date. At the same time, unlike in the spot market, investors in perpetual swaps do not actually possess the underlying asset. The contract is what is being traded and not the underlying. A great characteristic of the perpetual swap, as in its name, is that it can be held in perpetuity. This basically simulates the experience of owning the underlying asset. Other competing perpetual swap solutions can be boiled down to three limitations. Firstly, they rely on third parties to function. Basically, all existing perpetual swap contracts on the market feature trusted third parties. These contracts are prone to being censored, manipulated, exploited, and are inherently insecure for trustless financial transactions. Two, they do not allow for permissionless deployment of any market. Other perpetual swap contracts do not allow you to spin up a market for any asset. Currently, other solutions either require governance approval or a centralized party to create a new market. And finally, they rely on centralized or global insurance mechanisms. Existing perpetual swap contracts are prone to insecurity due to centralized management of an insurance fund or a global insurance mechanism. This results in a single market's volatility, wiping out and deleveraging other markets. Tracer's perpetual swap is engineered to scale and to give traders the highest on-chain leverage with secure, efficient insurance pools and risk-free liquidations. No other platform offers market deployment for perpetual swaps without permissions. What this means is that any market for any asset can be created utilizing Tracer's perpetual swaps without any difficult barriers to entry. The only requirement is an Oracle price feed. The Tracer perpetual swap is a generalized smart contract design that will serve as a universal standard for engaging in perpetual swap agreements. Tracer perpetual swaps coordinate all market agents in a manner that is permissionless, low cost, and most importantly, trustless. Long and short traders, as well as liquidity providers, have the option to trade through an order book mechanism. With this design, the Tracer's perpetual swap can be leveraged for all markets globally. So as alluded to previously, perpetual swaps enable the ability for traders to make leverage trades. A colleague of mine once said, trading without leverage is like driving a sports car, only in first gear. Traders may become more certain about a particular belief, but they start to borrow funds to increase exposure in the chosen position to maximize gains. In order to borrow funds, traders must put down a collateral. This is known as margin, which is kept in their margin accounts and is the amount that is affected during the price shifts for trades. Leverage trading is a mechanism that allows a trader to finance an investment using a combination of margin and borrowed funds. Leverage is the ratio of a trader's notional value or total value to their margin. 1x refers to a regular trade with no leverage, only using margin to make the trade. 2x refers to a trader using 50% of their 50% margin and 50% borrowed funds to finance a particular trade. The introduced concern when making leverage trades is maintaining a certain level of margin as collateral against borrowings, known as a maintenance margin. Just like margin trading in traditional finance, if this requirement is not maintained, traders undergo the risk of their positions being liquidated in times where a trade is moving against the position. This is also known as a margin call. Liquidations will be explained a bit later, but for now, let's follow an example for perpetual swaps. We follow Alice and Bob, two traders looking to get exposure to the price of Tesla. Alice speculates that the price of Tesla stock will increase and wants to gain long exposure to the price of Tesla using USD. Alice initially deposits $600 USD into her margin account and then decides to purchase a $600 long position worth of Tesla at a price of $600 USD. This is equal to 1 Tesla. On the other side of the trade, you have Bob. Bob wishes to gain short exposure to the price of Tesla and finds that the Tracer Perpetual Swap offers quick access to make a short position. Bob also deposits $600 into his margin account. He then purchases a $600 position of short worth of Tesla and is effectively matched with Alice. The next day, the price of Tesla rises to $720, a 20% increase in price. Alice has profited with a net gain of $120, whilst Bob has incurred a loss of $120 from his short position not paying off. In this case, the amount that was lost from Bob's margin account was paid to Alice's margin account. This is an example where Bob and Alice are not utilizing leverage and are simply trading at what would be considered a 1x leverage ratio. Now let's introduce leverage into the equation. Both Alice and Bob deposit $600 into their margin account just as previously done. Alice then purchases a $6,000 long position worth of Tesla, even though she doesn't have the full value of the margin required to make this trade. She is able to finance her trade using a 10x leverage to raise her equivalent margin to the required amount needed to purchase the position. Likewise, Bob purchases a $6,000 short position using 10x leverage and is matched to Alice's order. The next day, the price of Tesla rises to $606, a 1% increase in price. With a 10x leverage, the price impact equates to a 10% increase in margin account for Alice and a 10% decrease for Bob, as 10 times 1% is equal to 10%. Alice receives a net gain of $60 that's paid by Bob. So what is the funding rate? The funding rate is the interest rate mechanism to peg the derivative price to the price in the real world. It's effectively the core mechanism that allows perpetual swaps to function and remain in sync with the underlying market. Perpetual swaps value at any given time is represented by its mark price. This is the price of the derivative contract. The basic idea of the perpetual swap is that it should be worth about the same as its underlying asset. The underlying value represented in the system by the index price, which is the real world price that is provided by an oracle. We'll discuss the oracle component of the Tracer protocol in a bit more detail later on. When the index price and mark price are the same, the perpetual swap is worth the same as the underlying, and all as it should be. When the index price and mark price diverge, the system transfers a funding rate between the counterparties, long and short, to ensure that the perpetual swap derivative accurately simulates the experience of holding the purchase asset. This rate, the funding rate, is calculated by the formula depicted in the slide there, premium times sensitivity. The premium is equal to the difference between the market price and the fair price as a percent. To be more stable and scalable, the premium used in the equation above is adjusted with a time-weighted element, which is an average from the past 3 months. The fair price is the index price adjusted by a time value component. Sensitivity is a multiplier that is applied to the premium. The sensitivity is best designed to be at lower values for asset prices that are historically volatile and higher for less volatile assets. Sensitivity can be changed by Dow governance for each specific market. Funding payments ensure that the price of the perpetual swap derivatives tend towards the price of the underlying asset. A positive premium indicates excess long demand for the derivative and requires longs to pay shorts. Likewise, a negative premium indicates excess short demand and requires shorts to pay longs. Agents are incentivized to sell their positions when they have to pay funding, while demand increases for positions receiving funding, bringing the fair price toward the mark price. Funding payments are continuously paid, with the rate of payment being updated every 8 hours. This mechanism ensures that individuals are able to buy and sell the perpetual swap derivative at a price close to the fair price. So we'll now give a quick explanation of combinations of the varying mark and fair prices. As you can see in the diagram there at point 1, the mark price is above the fair price. This indicates that there is currently more demand for long positions. This is signaled by a positive sign for the funding rate, where longs pay the shorts. The mark price is drawn to the fair price as long positions are incentivized to sell their positions. At point 2, the mark price is below the fair price, indicating more of a demand for short positions. This is indicated by the negative sign for the funding rate, where the short positions now pay the long positions. The mark price is also drawn to the fair price as short positions sell their positions. So next we'll be discussing the liquidation and insurance fund mechanisms. Insurance is a key component of the Tracer Perpetual Swap protocol. The insurance fund is what guarantees that the liquidators are paid for their active service in securing an individual perpetual swap market. It's important to remember that because there are no central parties or intermediaries in the equation, there has to be a trustless insurance mechanism in place, which can't be exploited or gamified. So each perpetual swap market, like ETH USD, has a specific insurance pool localized to that market. This allows for market autonomy and scalability, and also promotes global protocol security. If you have an individual market that is extremely volatile and blows out, it doesn't spill over to affect other markets. The insurance fund accrues capital in two ways. One, the insurance funding payments from leveraged traders. A variable insurance funding rate is paid from leverage agents into the insurance fund. Each market-specific insurance fund sets a funding target. The funding target is set as a percentage of the total amount borrowed by traders for leverage trades, also known as the market debt. A typical value for the funding target is 1% of the total borrowed amount. As seen in the diagram, Alice and Bob both hold leverage positions and are required to pay an insurance funding rate to fill the specific ETH USD insurance pool. 2, individuals directly depositing into the fund in return for a proportion of the insurance funding payments. Agents may voluntarily capitalize an insurance fund through a direct deposit into the public insurance account. In exchange for earning a proportion of the insurance funding payment, private individuals deposit their funds and take on the risk that all or part of their deposit will be lost, covering liquidations that cost more than their remaining margin. Any user may deposit funds into an insurance pool to earn a proportion of the insurance funding payments. This amount earned is relative to the total share of the insurance fund, increasing the speed at which the fund is capitalized. For every deposit into the market-specific insurance pools, there will be an I token that is minted for the depositor, which represents their share of the insurance pool. These tokens are also interest-bearing if the insurance pool is below the funding target. For example, in the case of an ETH USD market, if an insurer deposits USD, they will receive an IUSD token that is specific to the ETH USD insurance pool they have deposited into. As explained earlier, traders are required to maintain the maintenance margin for leveraged trades. These margin requirements are set to secure the protocol as there is no intermediary. The risk is that an agent will become bankrupt and not be able to pay the counterparty who they are effectively in debt to. To minimize counterparty default, positions that fall below the required maintenance margin are deemed eligible for liquidation. In the example above, on day 1, the trader is holding a leverage position that is kept above the maintenance margin. On day 2, the price of the asset moves against the trader's position, causing the position to be decreased. This results in the position falling below the required maintenance margin, where it is deemed open for liquidation. Liquidation is the process in which a position is repossessed by a trader or agent that has adequate margin requirements. The agent liquidating the position is known as the liquidator. Positions below their maintenance margin can be acquired by any liquidator at a discount equal to the amount the position is below the maintenance margin. If this discount is greater than the gas costs of liquidation, the position can be purchased for a profit. To ensure the ability to fund this discount, the trader's remaining margin is placed in margin escrow to cover the liquidation costs, including the discount and any slippage costs. The margin escrow account ensures the trader that does not exit the position prior to compensating the liquidator. If the margin in the escrow account is insufficient to pay this discount amount, the insurance fund will instantly cover the amount. We'll now go through a walkthrough of the liquidation process step by step. So after receiving a heavy loss on a leveraged trade, the trader's margin drops below the maintenance margin. The trader's margin account status is now open, meaning that the liquidators are now able to liquidate the trader's position. A liquidator then liquidates and seizes the trader's position. In doing so, the liquidator receives a receipt as proof of liquidation. From here, the liquidator has two options. They can either hold the position, or they can actually sell the position. They can hold it if they think the position grants them benefit. If they do choose to sell the position, they can use the receipt to trigger the insurance fund to cover any losses associated with liquidating the position. As stated previously, these losses can be incurred from the accumulation of slippage and gas costs between the time of seizing and selling a position. The insurance fund then reimburses the liquidator for the position just liquidated. The liquidation design outlined above is completely inexpensive. Virtually all existing perpetual swap liquidation mechanisms charge traders a significant fixed portion, or the entirety of their remaining margin. Fixed fees for liquidation cause high leverage positions to be prohibitively expensive by charging competitively inexpensive liquidation fees. The Tracer Perpetual Swap contract enables traders to take on high levels of leverage, the reasonable margin requirements.
Okay, so we've lost the lights in here. The financial smart contracts that utilize any data outside of a blockchain environment require this piece of middleware called an oracle. In the case of perpetual swap we just discussed, the contract itself requires this oracle feed for the underlying asset's real world value. As we said, in that case, a Tesla stock price feed would be required. And each standalone tracer market will be able to choose their oracle feed, and deciding which oracle they're going to use can be based off of reputation, which is a great measure of oracle reliability, as you may know. Now, the security and reliability of oracles in the tracer ecosystem is absolutely paramount. Only when you have secure, reliable oracles can you build out a trustless financial contract that meaningfully interacts with the real world in any way. Reliable oracles meaning they don't fail, they don't experience downtime, or the low oracle security oracles mean that the contract supported by the oracle is vulnerable to attack. Obviously, if it's a single oracle, it's much easier to bribe or attack the oracle so that it reports a feed that changes the outcome of the contract in favor of a malicious actor. So to solve this, a distributed network of oracles is required with multiple redundancies in place so that if a single oracle or part of the oracle network fails, the feed of real world data is still guaranteed. Oracles aren't working for free, they must be paid for this service. And the higher the reputation and the reliability of an oracle, the larger fees that it will demand. Now, the fees generated from markets in the Tracer ecosystem will be used to pay for the oracles. And ultimately, Tracer will be able to use really highly regarded oracle protocols, something like Chainlink, and choose from an assortment of feeds that currently secure tens of billions of dollars in the decentralized ecosystem. So given this reliable oracle feed, Tracer can deploy on-chain trading for any market in the world. Now, these data feeds can be sourced by humans, IoT devices. There's a number of reporting methods possible. And some other examples of markets that the Perp Swap is capable of supporting are localized commodities, like a fuel price in your city. You could hedge against increasing fuel price by taking a long position for a given quantity of fuel that you intend to consume. In a very, very similar way, you could hedge your exposure to a deflating property market by taking up a short position on a local real estate index. And you could gain leveraged exposure to pieces of art, music, and other intellectual property, given that they have a liquid spot market already. And finally, you could go long on a bundled package, an ETF style, combination of stocks, commodities, ecosystem credits, pieces of infrastructure that align with your values and preferences as an individual. So let's come a little closer to home. Let's talk about this fuel price example. Now, most of you, I imagine, are familiar with this cycle where the cost of petrol oscillates around every 25 days. And we know how much it can sting when you fill up at the peak. But this cycle isn't always perfect. Sometimes it's disturbed. If you recall at the beginning of COVID-19 outbreaks, the fuel was close to $1 per litre in Australia. Imagine if you could effectively lock in that price for the next 10,000 litres of fuel that you buy. This is effectively what a long position on a perpetual swap contract allows you to do. And we'll step this out in a little more detail now. So let's say I work as a delivery driver and I want to budget my expenses more closely. I'm self-employed. In this scenario, I'm not looking to make a profit. I'm just wanting to reduce my exposure. So I wouldn't trade with leverage and I wouldn't be shopping around at any given location or time for the best price. I just want consistency and ease of access. So I fill up my tank at the same station every 7 days for 100 litres. The current fuel price is $1.28. I'm pretty happy with that. I'll lock it in for my next 5,000 litres. Buying derivative contracts way can be considered like buying price insurance. So as you can see on the screen, this is what my position would look like. Now, every time I purchase 100 litres of fuel, I have to sell 100 of my 5,000 contracts. So if the price of fuel is $1.35 in week 1, I pay $135 at the pump. I then sell 100 of these contracts, which are now worth $1.35 each, matching the spot price, and profit $7 from selling my position. We can consider this $7 profit to be an offset or discount on the pump price, and therefore I've achieved a net out of pocket of $120 for my 100 litres of fuel, or effectively $1.28. Now, say in week 3, if the price of fuel is $1.19 per litre, at the pump, I pay $119 and effectively have saved $9 compared to my desired out of pocket of $128. But my 100 contracts that I sold were sold at a loss. They went down in value from $1.28 to $1.19. And we can effectively offset this loss using a $9 pump saving. So we have achieved every week a net out of pocket of $128 for 100 litres of fuel. And this pattern can continue for 50 weeks or until I have no more outstanding contracts. Now, this is quite a small scale example, but it indicates how effective something like fuel hedging can be and how price insurance can be achieved for everyday consumption. We can foresee that simple applications built on top of Tracer can entirely abstract the flow out that I just described. So the individual doesn't actually need to manage the transaction. They can just lock in their desired quantity and price of fuel and continue from there. So let's recap what we covered today. First, Tracer DAO is a vessel which people can democratically use to vote on changes in the protocol, further enabling individuals who use the platform to have a voice on the agreements and systems in place. The DAO is what directly governs and owns the Tracer factory. Number 2, the Tracer factory curates contract templates, which can be used to permissionlessly deploy markets. This factory and DAO structure really creates an environment where financial innovation is directly incentivized, and we hope to see new markets be pioneered and explored. And finally, the Tracer Perpetual Swap is the first contract to be installed in the factory and will allow individuals to maximize their exposure via leverage or insure against volatility in a market. This is one piece of secure financial infrastructure that will be relied upon by many who wish to engage in perp swap agreements without having to trust their counterparty. So this kind of development really has only been made possible by the Tracer ecosystem. You know, we have financial engineers, software developers, security experts, academic research partners, all extremely focused on building this transparent, efficient, and ultimately fair financial system. So if you would like to get involved, please join us in Discord and Discourse, or check out more informational resources at tracer.finance. So we have about 10 minutes now left over, so we'd love to sort of discuss with you, hear some thoughts, and take any questions you have.
Yeah, thanks.
Yes, thank you. Thank you. All right, why don't I'll quickly introduce these talks first, whilst people are thinking about the tricky questions to ask you. How's that? So, yeah. All right, so in 2 weeks' time, we've got Raphael is going to talk about the state of blockchain interoperability, and he's a researcher in Lisbon. And then in 4 weeks' time, we've got networks of automatic market makers, and Daniel is going to give us a talk, and he's actually from Rhode Island, from a university there, Brown University. So those are going to be great talks. In addition, there's the Supply Chain on Blockchain conference, which is coming up, and the call for speakers is currently open. So head over to scobc.net and have a look. And the registration for that conference is free. The conference is in July, but the call for speakers is open right at the moment. So SCOBC. So that's enough from me. And yeah, why don't you stop sharing and let's have the people ask you some tricky questions. So are there any questions?
No questions means
could I ask one?
Yeah, go for it.
Yep, so I'll just ask it here. Yeah. So yeah, I've sort of looked at this space a little bit, and I'll just share in the chat just some things you might have heard about, like token engineering and CAD, and they've spoke about conviction voting and token curated registries, things like that. So that's some of that sounds quite similar to what Tracer is doing. So I am sort of wondering that, like, what are some of the incentives for people to bring the stuff that's going on, say, out in the wild and bring it into Tracer? Like, what's the advantage or incentive for if someone's innovating out in the wild to bring it into Tracer and have it go through that process?
Definitely. I think primarily what we envision, aside from really highly efficient mechanism design, so, you know, low cost. Well, I think you're still on mute, James. Did you have something else you wanted to add? No?
No, I was just listening now. Yeah.
Yeah, aside from the really efficient mechanism design, we're talking much cheaper, easier to access functionality. We're also envisioning for a really strong network and ecosystem effect, which obviously is very positive when you're talking any sort of financial tool market deployment. Yeah. Anything to add?
I guess your question also asked about what kind of incentives to bring in, right? So I guess, yeah, like incentives to come in are things like, you know, if anyone wants to kind of join for work, the DAO will directly incentivize them by meaning of remuneration or a proposal or contract, grants for development or research, those kind of things there.
So it's a combination of actually set remuneration. So like we said, grants for research and development or partnership agreements, and then the more subtle benefit of being associated with a strong network.
Okay, and if I could add one tiny question, who's behind Tracer? Like, is that the teams or public somewhere on there? I couldn't quite see it on the website.
Yeah, so the Tracers, behind Tracers, the DAO, and obviously us as Lionsmain, we're a development company that were, you know, contracted by the DAO. So we're helping curate the process of, you know, help developing Tracer, as well as, you know, basically lobbying for other parties to be involved with Tracer. So basically we're trying to, you know, outsource that to get other users involved with the DAO to, you know, help build the Tracer protocol.
The initial contracts were available, written by Lionsmain and available in I think January this year, and they were just found by different people in the network and the ecosystem, which resulted in the initial deployment and the beginning of Tracer DAO. So we're not sure who was behind that deployment, but Lionsmain is very excited to be working with them. I hope that answers your question.
Okay, so a mysterious deployment, and that's the machine is now running it. Okay.
Correct. So there are currently 100 initial governors, and I believe as of today, 50 new ones.
Cool. Thank you.
So I've got a question, which so we've got Compound and you've got, say, Uniswap, say they're contracts that people are using at the moment, and what you're doing sounds in some ways similar. So could you compare and contrast, say, with Compound and with Uniswap, so we can, understand how does what you're doing, or how does what Tracer is able to do relate to what those products are?
Yeah, I mean, we consider Tracer to be very similar to the Uniswap, especially in the perp deployment. That permissionless creation and trading between individuals is something that we're quite passionate about. So you would almost imagine a parallel between Tracer and Uniswap in that regard. And obviously in future, we're looking to utilize the open source system as it stands to create this network of multiple products, multiple offerings.
So yeah, I guess on top of that, offering multiple different financial contracts. So you've got Uniswap and Compound offering currently pretty specific financial contracts, where we're offering the ability to offer a variety and broad scale of different types of financial contracts and agreements.
I have a question. This is Fleur.
Hi, Fleur.
Can you hear me? Hi.
Yeah.
Just wondering who are your main users going to be? Are they institutions or investors or individuals?
I guess to answer that question, it's for everyone. Like we're trying to have that protocol that accommodates for any type of user. So I mean, yeah, institutional users can definitely use. If it's retail, we had the fuel price before as something as more intimately discussed on a personal finance kind of level. But yeah, the users are meant to be any type of user, market makers included, liquidity providers, insurance depositors.
Yeah, more specifically, perpetual swaps are quite an advanced trading tool. So initially we hope to see some really wonderful traders coming in from the community and exploring Tracer and working with perpetual swaps as the first contract.
Yeah. And when's your launch date? Because I see there that the testing has already been closed. So you're still looking for people to join the governance team?
That's correct. So at the moment, the alpha testing will be available for the testers towards the end of April, sometime around the 26th. Currently, the applications for governors are still open. So there's been a batching process taken by the Dow. Looking forward, there's probably about 150 further spots that will be batched by the application, which you can check out on the website.
Yeah, it's a very, very complicated and advanced derivatives products there that it's able to do. So it'll be for people who are really, really familiar with some of these derivatives.
Yeah, definitely, especially when you're discussing trading with high leverage, Fleur, that is quite the case.
I have a question.
Yes.
Yeah.
Thanks for the talk. Very educative, actually, and very looking forward to get this to the real world finally. So in terms of governors, what exactly do you look for governors? Is it a full-time commitment, or do you require any eligibility for somebody to participate as a governor?
Are you specifically referring to the current process for 50 the new governors coming in, or are you in general there?
No, not for the if somebody wants to enroll as a governor for the Tracer project.
Yeah, definitely. So it is our sort of belief at this time that a diverse DAO with a mix of commitment from individuals breeds the most effective governance. So in terms of recommendations, Lion's Mane recommends those who are experienced in the space those who are experienced in finance, but also on top of that, those who demonstrate a really large excitement for the movement that we're working towards. So it's quite an open floor at this stage. As we know, past behavior is not necessarily an indicator for future behavior. So we try, when we're making recommendations around governors, to understand and empathize and see your passion in your application. So it's almost anyone's game at this point.
Thank you.
I've got another question if no one else does.
Yeah.
Yep. So yeah, in the Petrol example, it sounds like it's going to be easy to use, so people can maybe manage their finances better a bit under the hoods. But with that comes trusting, obviously, the platform itself and the mechanisms behind it. Has there been, or will there be a type of security audit that goes into that, like sort of those similar attacks as well? And yeah.
So currently our code's being audited by Sigma Prime. They're an Australian company. We're going through that process actually, as we're speaking. So yes, the code is being audited and will be continued to be audited for any other financial contracts to come.
Excellent. Yeah, and I'm guessing that will also, I guess depends on the brief, but would it include those other types of attacks you can get with, like a DAO being able to influence the oracles and those kind of protracted attacks you can achieve? Like if there's this dependency on a DAO. Yeah, sorry, go on.
Yeah. When it comes to security of the DAO, so obviously the code base being audited by Sigma Prime is a different aspect to DAO governance. Currently we're in the process of, we've obviously thought a lot about DAO specific security, and some of the, things that we're going to be bringing into place and, have thought in the pipeline will be coming to surface as time progresses. But obviously we're at the current time where it's, we've thought about all the security, we understand the issues that are there. But yeah, we'll implement whatever needs to be done as time progresses.
Yeah, perhaps more specifically, James, you're welcome to actually check out the Sigma Prime participation agreement. It's available on the governance platform from Tracer.finance, and it outlines the full scope of the work to be completed by Sigma Prime.
Yeah. So I just presume if there's voting of sorts, then I guess there's tokens as well. So there's perhaps other token incentive models around that. Thanks.
Definitely.
Could I just ask a question? Is my audio coming through okay?
Yeah,
it certainly is.
This is all a fascinating new field for me, but I'm really interested in how the project is funded and how presumably Lion's Mane is not doing this with no, on the smell of an oily rag. There must be some flow of funds to stand up a project like this and to keep it going. Are you able to share with us how that process has evolved?
Absolutely. So Lion's Mane are funded large in part by currently a group called Mycelium. And as Lion's Mane, we are all in on Tracer. The Tracer Treasury, as part of our agreement, will be paying Lion's Mane $75,000 per month once there are funds available in the Treasury. For now, we are actually bootstrapping. We haven't accepted any external funding. And as I said, not currently receiving money from Tracer DAO, but will do once the Treasury has funds. More specifically on Mycelium, we're a subsidiary and being currently, supported in that manner. It's quite a big team, but we're very invested, obviously, in the outcomes of Tracer and the building of Tracer by Lion's Mane. So I think that answers your question. Yeah, subsidiary support until DAO funding is available.
I've got another question, just following on from Pierce's question with regards to funding. Will you be looking at issuing an ICO to fund the development?
So no, not currently in the plan of doing ICO. Obviously, we're also contracted to the DAO as Lion's Mane, so we actually can't make the centralized decisions. So, as time progresses, it's completely, up to the DAO, if the DAO by proposal, if it goes through or not. But currently we have no plans in providing ICO to the public.
All right. So look, thank you, Izzy and Adam. That's been an awesome talk. The fact you've had all these questions is should be very encouraging for you. People are interested in this tech. So if anyone's got further questions, I'll post the video on YouTube probably later today and put comments in on the video, and I'm sure that your questions will be answered. So thank you everyone for joining the call.
Thank you so much, Peter, and thank you everyone.
Thanks for listening.
Bye.
Cheers.
Keep up the good fight.